Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 4:30 in New York. It is Thursday, 4th day of May, 2017, and this is the Daily Report for Gold and Silver. Following a dramatic price break and sell-off yesterday, which of course has been a continuation of the selling pressure that has been evident in the market over the last couple of weeks. Today, we saw a dynamic continuation of that, breaking through key levels, specifically the 50 and 200-day moving average. Gold futures closed down about $20 on the day, $19.20. Net change, the closing price $12.2930, and that's after trading to a low of $12.2570 and a high today of $12.4170. Spot gold, same closing price, $12.2880. However, the net change is only off about $9 because it is accounting for trading during the evening session. Net drawdown 0.72, about 0.75%, and about 1.5% when we look at gold futures. Silver futures also under dynamic pressure, but not nearly as much pressure as in gold. 1641 off 13 cents. That is basis most active futures contract in silver. And then with spot silver, very, very similar closing price, 1640, 1639.6. Absolutely no doubt some key selling pressure in the market this week. I want to start today's chart section by looking at the weekly activity up till now, and it's Thursday, so we've had a majority of the week go by. But take a look at the size of this long red candle, which of course indicates the entire range traded. Of course, we are sitting currently at 1228.60. If you notice, 1228.70 is a 50% retracement. However, it's a 50% retracement of the smaller move. I'll call it the second leg of this rally, this being the first leg of the rally here, which took the market up to roughly 1260 plus. The subsequent correction taking the market back down to 1200, and then we'll label this the second leg. When we do that, we can see we're plumb up against that with the 61.8% retracement just below it at 1220. However, with this kind of selling pressure, we really want to look at the entirety of today's or of this year's range. Of course, back in December of last year, markets at 1120. If we define this as a single rally here and then look at retracement points, and that's what these particular marks are, we can see our 50% falls at 1211 and our 61.8% below 1200 at about 1190. So while selling pressure could stop at any moment, if it does continue, these are the different points that we need to look at. Now, what we're, at least myself, is attempting to determine is this selling pressure that came in this week, to me, is more than just premium coming out of the market that was baked into the market when there were more concerns, I should say, about North Korea, the tension that was there. We've got the election coming up in France. Of course, the candidate that the most worrisome candidate is now behind quite a bit, so that's more of a long shot. So with those fears kind of moved to the back of the bus, so to speak, it allowed premium to come out. However, I'm not convinced that the totality of this move was only premium, because that's quite exaggerated in terms of where the market came in. I think that what we're witnessing is some of the stronger players attempting to shake out the weaker players, a shake-up play where they're running stops, moving the market down and looking to push out weaker players that can't afford to hold their longer-term positions. That's my sense anyways. That being said, there is still a case to be made for the potential that we are still in some sort of a bull market, although a week like this diminishes that considerably. But as long as we look at our rallies and then our subsequent defined corrections within guidelines and parameters, meaning if we stop, especially by 1220, which is a 61.8% retracement of this second leg of the rally, a case can certainly be made for a series of waves in the market, peaks and valleys that fall within accepted guidelines of different models that we look at. And one of the basic models that all technical traders, not all, but the majority do, is the fact, whether you call it Elliott wave or whether, no matter what you call it, that markets tend not to move straight up or straight down. They do it with a series of aggressive rally modes and then a series of corrective points in which it gives back a portion of the gains. And the key word there is portions. As long as that continues, of course, where you have these defined corrections as deep as 61% of the subsequent rally, you can still make a case for a bullish model. All bets are off, though, if the market really breaks hard below those price points. And we are currently just at those price points. Let's see how this week washes out. I don't expect any kind of a great rally tomorrow, but let's see if the selling pressure continues. Of course, we will remain flat this market with no active trade and await our next signal. In other markets that we follow, interesting day. We did have some action up in the hill with the healthcare plan actually passed, gone through Congress. Now it needs to go into the Senate. Jobs report coming out tomorrow. The anticipation is new jobs added. Non-farm payroll will be about 190,000. I think that all of that has been factored into current pricing, both in gold and silver as well as equities. If it comes in on target, I don't expect big knee-jerk reactions. It would be an estimate that was way off, way high, or way low that would change that. A Dow down about 6-7 points today, 20,951. A Standard & Poor's up just slightly on the day, and then NASDAQ also up real slightly on the day. However, the big mover was a 5% decline in crude oil. Crude oil breaking through all kinds of barriers, closing at 45.43. Closing off about $2.39 per barrel. And as I said, a net change of about 5% to the downside. We will certainly want to look at a crude oil chart. And then lastly, when we look at the U.S. dollar does trade under pressure today, losing about 0.5%. But as we talked about in the gold and silver section, it was not enough weakness to curtail the massive selling in gold and silver. One of the interesting facets of recent trading activity is both crude oil paired in dollars or traded in dollars, gold and silver traded in dollars, even with a weak U.S. dollar, could not get out of their own way. In other words, it didn't provide enough strength to even keep it even. Crude oil closing off by about 5%. Right now it's 4.85% at 45.50. That's our current print down here. We talked about the fact yesterday when we talked about crude oil that we had a dynamic break a few days ago below the long-term 200-day moving average. We broke below that shorter-term 50-day moving average a couple of weeks ago. We talked about various levels that I would look for. Now, realize this was yesterday. I said the first level we could look at would be 47, and that was simply based upon these series of lows that came in. I said that we had another minor level, I believe, at 45, which with our major level down near these bottoms that come in at 43. I didn't think we would see the kind of move we saw today. This market just melted away, but we've seen this action in crude oil before with these dynamic moves down, such as here, also here, and then today itself. So right now my target is at minimum 45, but we could see this market go back to 43 with the lows, the recent lows, or I should say of 39, 42 that came in end of November, December of last year. Those levels now are certainly achievable. And traders, while we are on the subject of different commodities such as gold and oil, silver that are paired with dollars, as I said, the dollar under pressure today, and the key as far as I'm concerned today is the fact that we had this solid close really below. This is our long-standing 200-day moving average. This is that dashed red line. We have been flirting below that. Yesterday we came right up to it, but we had been trading in essence in a highly congested sideways market activity for the better part of the end of April. Today, though, we opened above that price point. Take a look at this. It opens above the price point and then closes solidly below it. This is coming after a defined downtrend, so you can't label it an engulfing bearish per se. It isn't engulfing bearish in terms of the straight candlestick pattern, but in terms of criteria, it's not where you typically look for this particular pattern. In fact, there is a pattern called a last engulfing bullish and a last engulfing bearish that are exhaustion patterns which occur like this. In other words, after a defined downtrend, you get this engulfing bearish. It's the potential that this pattern is signaling some sort of exhaustion. At least that is what the Japanese technicians state when looking at this formation here. But the key is this: we had a solid move below the 200-day moving average. It has been trading below the 200-day moving average. I think we have further weakness in the US dollar. That might not be the way we see it trade over the next day or so or week or so. But longer term, I think we are headed for a dollar that has a lower value than currently defined. Traders, absolutely no doubt, we have seen some dynamic selling pressure. Last week, we saw a little bit. We saw, of course, the top of the market that came in 2 weeks ago when the market traded to a high of 1297. We saw the fact that it was unable to break above that long-standing resistance that we talked about when you draw a line from all of the tops all the way down to current pricing. That's exactly where the market stalled. Last week on Friday, we identified a variation of a three-river evening star. The reason I called it a variation, simply put, is because the red candle, it was a lower close last week, but it wasn't a large red candle, and we said that we'd have to see that kind of continuation this week. We are certainly seeing it. This week we have seen this market dynamically sell lower, giving up a lot of equity, and the question is, where will this market become oversold? Because now that we have broken through a 250-day moving average, the next real targets, as we talked about, are what, 1209 and 1190, and those are based on a 50 and 61% retracement of the entire move. So traders, we've been flat. We haven't profited from the downside, although some of my aggressive subscribers have. They know that when I'm not in the market, it might be a time to get short. But my job is to position ourselves properly, whether you're trading the cash market, the futures market, or you're purchasing physical gold. And that's one of the primary reasons that I initiate long positions, the vast majority of my trade recommendations. We certainly didn't lose any money as this market went down, and we are looking for an entry point, a key entry point that will provide us with our next profitable trade. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.